This video is all about how to analyze the potential market impact of upcoming political events. How would uh, expected political events affect the the market? How will it impact the market? Number one is understand the political landscape. First of all, you need to have a clear understanding of the political landscape. So in this case, you consider party platforms. Consider party platforms. So you analyze the economic and regulatory policies of the parties or candidates involved, especially regarding taxes, government spending, as well as business regulation. Usually during campaign, the candidates will tell the electorate, will inform them about the policies they are going to implement if elected to office. So you analyze those promises politicians are making. So changes in fiscal policies can significantly impact market sectors such as healthcare, can affect the energy sector, can affect technology sector, and many other sectors of the market. Moreover, you have election outcome scenario. Election outcome scenario. So you consider the potential outcome. Potential outcomes including, who is likely to win, which party controls Congress, and whether there will be a significant shift in policies that could affect investor sentiments, that could affect investor confidence. So you consider all this, particularly the party that would control Congress. That's the central law-making body of the government. Number two is market sensitivity to political events. Market sensitivity to political events. There is this volatility around elections. The stock market tends to be volatile during election periods. So election can cause short-term market volatility as investors react to uncertainty in the political climate. They react to uncertainty. And so the closer the election, the higher the market sensitivities to campaign promises, to debates, as well as polling trends. People will analyze polling results. Which party is likely to win? Which one is not likely to win? Which candidate will win? Which candidate will lose? So they react to polling trends. Nevertheless, you also consider market reaction to polling dates. As the date approaches, the market reacts accordingly. So as polling dates, as the date approaches, you discover that it will affect, the electorate. It will affect market participants. Not only the date, even polling data, the data coming out. If it favors a particular candidate, the market will react accordingly. If it doesn't favor a particular candidate or party, the market will react accordingly. Number three is impacts of political policies on specific sectors. Impact of the policies of political parties to a specific sector of the economy. So in this case, you have tax and regulatory changes. Tax and regulatory changes. You may have tax cuts, new regulations, or stimulus packages. These items can benefit or harm specific industries. For example, pro-business policies may lift stock market in sectors like finance or manufacturing, while environmental regulations may impact the energy or the automotive sectors. Even policies support green energy, green technology, sustainable agriculture. Those policies will affect relevant relevant sectors. And you also consider trade and foreign policies, trade as well as foreign policies. So this actually assesses how candidate foreign policies, including trade agreement and tariff, may influence global trade and international stocks, especially in export-heavy industries. And if the candidate is the type that will want to show strength, military might, peace through strength, then you might expect an impact in the defense industries amongst defense contractors. So number 4 is economic forecast and political risk. Economic forecast and political risk. Please do well to subscribe to this channel and also like this video. you know you are in a political science class this time around. You are delving into politics. You just have to, because it certainly affects the stock market. We can't disregard politics. We must take into consideration how it affects the stock market. So as a well-rounded students of the market, you should know precisely how these factors affect the market. That's why I'm bringing these videos, this kind of political series to you. So number 4 is economic forecast and political risk. So in this case, we're considering macroeconomic policies. Macroeconomic policies. So you pay attention to how political candidates plan to address economic issues such as inflation, unemployment, or national debt. These factors can drive long-term market trend, especially in the stock markets and bond yield. Even interest coupon on bond could be determined by the prevailing political climate. It's not only the stock market that could be influenced by politics. Even the bond market, bond yield, interest on bonds could be determined by prevailing market circumstance. So you have political stability. Consider the potential for political gridlock or instability post-election. A stable political environment tends to favor economic growth and investor confidence, while uncertainty can cause the market to gyrate, to fluctuate, to swing. It might introduce unnecessary volatility. Number 5 is market sentiment and poll trends. That's the outcome of the poll they take and the prevailing market sentiments. So you have pre-election market sentiments. People are just there's uncertainty, as regards to who will win and who will not win. And that sentiment will percolate into how, it could affect the markets. So watch for how investors react in the lead up to the election. Strong support for business-friendly policies tend to drive kind of market optimism, while concerns over new regulations can cause market hesitation. And then we'll consider post-election market adjustment. There's pre-election problems, pre-election. In my country, we call it wahala, pre-election wahala, and then, it doesn't stop there. When a particular candidate eventually wins, then how will his policies look like? That one too will come with its own bag of anticipation, expectation, and influence on the markets. And so pre-election market adjustment, post-election market adjustment. So following the election, market typically adjusts to the new political reality. So positive results for business policies can lead to stock rallies, while concern about policy changes can trigger sell-offs. If things are not very favorable, people will now start dumping their shares. The whole thing looks somehow interesting. People may no longer consider company fundamental. They will just react based on the political climate. And I wonder how individuals will react in such, a pattern. And so to assess the market impacts of elections and political policies, you monitor the political landscape, understand the market sensitivity to election, and analyze how proposed policies will affect different sectors. Not only that, you pay attention to market sentiments, polling data, as well as polling dates, as well as data, and the potential for political risk, all of which can influence stock market movements in the lead up as well as after the election.